we all knew that this was looming. We all knew that March 4th was going to be the deadline. And I guess there was always that hope that a deal would be struck, that this was, in fact, a negotiating ploy. And yet we are here at the 11th hour, almost virtually, and we have nothing.
Yeah, and it comes after a slew of kind of a slow drip of negative U.S. data over the last couple of weeks. So I think people are a lot less concerned about, tariff implications on inflation than they are really on growth. And I think that's where we've come to. And the market has been telling stories or giving you signals about this, for the last, I would say, 3 weeks to a month. And the volatility, we're going to talk to Mandy Chu later on in the show. I mean, it's fascinating. If you're Meatloaf, 2 out of 3 ain't bad. It's not, it's one of your favorite songs. If you're the market, 2 out of 3 is really bad. And you think 2 of the last 3 days, we've had big sell-offs. Friday looks a little bit like a mirage. And it sets you up for a payroll number on Friday that suddenly looms really large. That if you see some deterioration in the job market that looks material, people will put it together with the concurrent jobless claims number that we got last week. So be careful.
Yeah.
Well, that gets to if you knew what it was going to say.
Right.
I don't even know. Let's say we get a number that's weak for jobs. Then you start to think, all right, well, the Fed is really back in play again. And it goes from, actually it was up today, I guess, to 2 and change cuts, rather. Maybe we go up higher. That has historically, the last couple of years, been somewhat of a floor. But maybe bad news becomes bad news. I don't know. So I think something sort of right up the fairway is better. Right. Than a weaker number that would allow for cuts.
I mean, it's interesting. The argument that the Fed put will be back in play if the jobs number is a disaster seems interesting, given so many Fed officials have said that we look through tariffs. They wouldn't be reactionary necessarily to policy. And so therefore,
when you say, wait, that we look through tariffs,
like it's a transitory sort of, they wouldn't adjust policy just on the fact that tariffs are in place.
I thought they were saying last time, we're going to wait to see what tariffs do and what effect that has. Because
that's what I've heard.
The transitory thing.
I think it was 50-50. I think 50% of them said that they were going to preload it and say that it was going to be inflationary. And the other 50% said, we'll wait and see what it looks like once they're imposed. So, but either way, when you look at it, is it a carrot? Is it a stick? We don't know, but you kind of lose the stick if you just always say no. We're just going to. That's why he said that there's no way they can avoid it, because if he says there's a way to avoid it, the market's never going to trade on it, right? And is that clear or no?
Well, why does he want the market to trade on it, though? Why does he want to invoke?
I don't think he wants the market to. That's better. I could say it better. I think he wants Canada and Mexico to react. This is about immigration, and this is about fentanyl. Mm-hmm. Though it has nothing to do with the market right now. Mary Barra has avoided 50% of the tariffs. Ford can't. And she said that without deploying any capital, they can avoid 50% of the tariffs. I don't know how she's doing it, but maybe she should call Farley. So there's some companies that are going to be able to avoid it. Some companies are going to have to bring their plants here. Mm-hmm. Other companies are going to have to soft shoe it. She's figured out a way.
Well, okay. Well, bringing manufacturing facilities here, or this whole nearshoring thing, that's inflationary. I mean, there are many scenarios in which the end result is higher prices. So that's what we're digesting now.
And that's what markets are trying to figure out. And even the Fed, right? I think in theory they're saying, yeah, we can look through this. We're just going to see how it plays out. But how do you actually weed that out from the data, I think, is the other question, right? And so I think when it comes to the Fed, there is still that realistic possibility that they're going to look at some of these jobs prints or whatever the numbers are, and they might still be able to react to that. And that's why you're starting to see there's a higher chance of rate cuts happening later this year. And, I think when it comes to this, too, it's really affecting consumer sentiment. Like, you're looking at those AI investor sentiment levels. Bearish levels are above 60%, which is what it was a couple of years ago. So you're just getting, whether it's investors, whether it's consumers, like, people are just not willing to put their money where their mouth is. And that, I think, is the bigger concern than the tariffs themselves, is what is it doing to the consumer sentiment right now? And that's really what you're seeing happening.
I mean, we saw that in the sentiment numbers in terms of one-year inflation expectations.